Good to be back in the briefing hot seat. It's been a while, feels like. But, last big day of the year, for sure. The Fed step up and deliver their final verdict of 2016. And we'll talk about this, of course, during this briefing. Currently, we are locked in with the rate hike almost a shoo-in here as far as meetings go. This doesn't get much more kind of categorical in terms of market expectations. So I'll talk about that in a minute, but firstly we can't ignore the fact that ultimately we've had another punchy session for equities yesterday. And if I just enlarge a couple of charts here, let's just start with the S&P and US equities rifling higher. Another clean, nice break of that high we had back on the 11th. And if we just go to a weekly chart to kind of get this in perspective on the longer term, last week was very punchy on the upside, and we've added a touch to that this week. We've only had a couple of days and we've got the Fed to negotiate, of course, but as it stands, we are, well up through previous highs. This is the highest, of course, this index has ever traded. The main story here. The main underlying theme is, of course, despite the fact the kind of major risk events of the second half of this year have all materialized in what was perceived as the negative outcome. I mean Brexit, I mean Trump, I mean Renzi, and ECB tapering. You might want to throw that in there as well. But obviously these are all the negative outcomes, and yet, of course, equities have gone through the roof. And this is because, for now, traders and investors are happy to, two things. Traders and investors are happy to kind of alter their, post-US election Trump verdict away from the catastrophe they thought it was going to be before the election and through to now quite bullish. And that's because of two things. Number one, Congress being Republican, and number two, Trump reversing a lot of his sort of thoughts with regards to the kind of controversial side of his policy ideas that he was rolling out during the campaign, reversing or at least watering down his stance on immigration and on Mexico, reversing the idea he's going to scrap Obamacare. And now, indeed, from a comment from Hilsenrath from yesterday, now it seems that he's Yellen's biggest fan, and that interest rates should stay lower for longer, despite the fact during the election campaign he couldn't have been more critical of the Fed and the idea he was going to remove Yellen. Second day in office, she's out, and we need to get rates off the floor. This is ridiculous. This kind of rhetoric has mysteriously vanished, and so what we're left with is this fiscal stimulus package that currently people are big time pricing in. So that's the big reason. Followed, and as a result of that, a shift in expectations with regards to growth and inflation in 2017, which has led to a rotation of assets out of bonds, and with a lack of better alternatives, pumping this money into equities, and perhaps also riding this idea that you're going to get corporate America, or the big, I should say, multinational corporate America, repatriating cash as Trump gives them a tax window when he gets into office. So these are the things, why this is happening. These stories. It's worth just reminding you of that. What happened yesterday, if we just go slightly shorter term, this is kind of coming back to one of those key risks that I mentioned, and that's Italy and Renzi's referendum loss, but perhaps more specifically Italian bank risk. Well, we had a good day for Italian bank risk yesterday as UniCredit announced a quite eye-wateringly large 13 billion euro rights offer to kind of shore up its balance sheet. They announced, I think it was 12,000 job cuts. They also announced cost-cutting measures. They're the cost-cutting measures. Sorry, they also announced an 8 billion euro non-performing loan clean-up plan. Emergency, kind of desperate desperate stuff. Some of these figures are just massive. 13 billion euro rights issue. Anyway, their share price was very volatile, down 6% to start with, but finished the day up 16%, and dragging the rest of the Italian banking sector with it. So, it's a step in the right direction. It's two ways of thinking about this, really. Number one, thankfully they've made a big statement here, and they're really making a big effort to kind of patch things up. And, good news. The other way to look at this is, how the hell does a bank of this size get itself in this position that it requires desperate measures? And, surely is it too little too late? That's the kind of pessimist's view. For now, markets are happy to go with the optimistic outlook. But equities through the roof. Quite an interesting stat for you. I'm just going to switch screenshot briefly, just to touch on the Dow Jones. And the Dow Jones, as you can see on the chart here, briefly got up above. This is a daily chart. The top section of this chart is a daily bar chart for the Dow Jones Industrial Average. We did sneak above 19,900 briefly. What it's looking at the bottom of the chart is the RSI on a daily, and this touched above 87 yesterday, and here's the stat, that is a 2-decade high for the RSI's value on the Dow Jones Industrial Average daily chart. Obviously the price is an all-time high, but the RSI, that's a 2-decade high in terms of its overbought status when purely you look at that one indicator. It just goes to show how far this index has come in such a short space of time, of course, since the election chaos, and then really it's been one-way traffic. The kind of election area of this chart saw the Dow below 18,000, and here we are knocking on the door at 20,000. So obviously quite dramatic reversals. So let's talk a bit about the Fed. Here is a couple of charts, and this is the big event for today, although it's not coming till tonight, of course. So the rate announcement and the statement will be released at 7 p.m, and then Yellen will be in front of the press and delivering her comments, and a Q&A session that will start at 7:30. Really, we're not particularly interested in the rate decision because, as you can see on the top section of this screenshot, that is the probability of the Fed hiking rates today. And as you can see, quite amazingly, we have literally hit 100%. So, to say the least, people are expecting a hike, and markets have priced a hike. If there is a hike, then it's irrelevant. Of course, if there is no hike, well, then it becomes one of the most dramatic monetary policy events of the year. Okay, and then, of course, from a trading point of view, happy days. That's ideal because markets are fully priced for a hike, and if there isn't one, well, that's trigger the chaos and dramatic market reversals as we price back out the hike that we've got fully priced in. Of course, there's going to be a hike. If the Fed can't hike today, then not only is that dramatic, I mean, that really is, I would say, for me, I would completely lose respect for the Fed. The Fed would entirely lose their credibility, and I would say it's probably, should be Yellen's last ever decision. If she decides to hold today, then there's definitely something spectacularly wrong with that institution. But of course, they're not going to make that mistake. They'll hike. Look at the bottom of the chart. This is just looking at how we've seen markets behaving, just over the last 6 months, actually. But we're looking, I guess the dollar index is the blue line where we've seen a nice push to the upside, of course, since the election. And then you've got sovereign bond markets moving in the opposite direction. This is the really kind of pronounced diversion that we've seen, and this clearly represents the pricing in of a full Trump fiscal stimulus program rolled out in 2017, and it having a large effect on growth and inflation. Personally, I actually think this is now overpriced. Firstly, I think there's risks on the two sides. Number one, will Trump be able to deliver his full package? Because Congress are in the way of this, so you might see that the package that ends up getting delivered is slightly watered down than the one Trump has been promising. And then number two, I mean, is it going to work? Ultimately, if it doesn't drive a big increase in growth, then the Fed have got a bit of a problem, because they're going to have to borrow a lot of money to fund this, and they've already got a debt to GDP ratio above 100%. So there's not much margin for error if it doesn't pan out the way they want. But anyway, the Fed are going to hike. Let's look at another kind of interesting graphic here, looking at how markets might behave today. And as I said, it's not about are they going to hike, it's more about their forward guidance. And actually, before we look at this graphic, let me just show you something else. This is very interesting. This is looking at, well, firstly, the chart on the top. That's a long-term view, 26 years, 27-year view of Fed interest rates. And you can see the cycles, and then the crazy kind of zero flat line here for like 7 years straight, locked in on the floor, and then the tiny little hike that we had 12 months ago. Of course, we're still right at the very bottom, all-time record low for rates in the grand scheme of things. But what's interesting about this graphic, it's looking at, it's comparing previous cycles. So if I just go back up, sorry. We're looking at the previous hiking cycles here. So the hiking cycle that took place in the mid-90s, and then the hiking cycle that took place in the mid-noughties, let's say, before then the financial crisis and the move to zero. So what we're doing here on this chart is looking at, now that we're most likely going to get the Fed's second hike in the cycle, when did we get the second hike in the cycle last time, on the last two times? And it's looking at different factors here. So firstly, on this one, in both of the last two cycles, the second hike in the cycle took place around about 3 years after the end of the last hiking cycle. So what's very notable here is it's 7 years, 6 months since the end of the last hiking cycle. And no, it's not since the last hiking cycle, apologies, it's since the end of the cutting cycle, apologies. So we're 7 years, 6 months since the Fed stopped cutting, which is obviously more than double the amount of time that we normally get. So that just means that rates have stayed lower for a hell of a lot longer than they ever have in any other cycle. In terms of employment, the employment rate is a lot lower than it has been in the previous two cycles when the Fed hiked for the second time. In fact, in the 90s, they hiked for a second time, even though unemployment was at 6.5%. Looking at labour force participation rate, and this offsets and explains some of the reason why the unemployment rate is low. The participation rate is low. That's not a good thing. So that it kind of offsets and explains the unemployment anomaly. On earnings, then actually earnings, S&P corporate earnings are higher than they were the last time in the last cycle in the mid-noughties. Inflation, however, is a lot lower than it has previously been, and in fact the last two cycles the Fed waited until inflation was above 2% before hiking for a second time, and indeed in the 1990s inflation was at 2.8% before they hiked again. So this explains one of the reasons why the Fed have been waiting so long. Core inflation's also lower than it has been in the past cycles. This is quite interesting. Exports as a share of GDP has climbed quite a lot relative to where it was in the previous two cycles. However, this may be more of a function of the fact that GDP growth is really low. Look at the bottom line. GDP growth in America, 1.6%, which is more than half of where it has been in the previous two cycles when the Fed hiked for a second time. So again, another key reason why the Fed have been waiting so long is a real lack of growth, really low inflation, and then global risks. Okay, but it's quite interesting to just compare this hiking cycle to all the others, and it's a freak of nature. What has been going on since the crisis, the period of time we've had rates at zero, and now the speed of the hiking cycle are both absolute anomalies, the like of which we've never seen before. Just going back to look at that graphic. Actually, no, I'm going to come back. I need to show you one more thing first. Two more things. Here's the Fed funds futures, and they're pricing a 91% chance of a hike. I mean, it's a shoo-in. They're going to hike, and it's going to be a 25 basis point hike, of course, nothing else. This is an interesting one then. So given that the hike is priced in and it's going to happen, what's the more interesting and important part of the meeting? It's actually about the Fed's guidance towards 2017, and that'll come in the shape of a few different things. I'm showing you the dot plot matrix here. I'll talk about that in a sec. We're also going to get updated forecasts for growth and inflation. So every quarter, the Fed have, or let's say every other meeting, the Fed have a meeting every 6 weeks, of course. Every other meeting, so actually that turns out to be once a quarter, we have a really significant meeting where they update their annual forward-looking growth and inflation forecasts. They then also update this thing, it's called the dot plot. This is where every Fed member plots on the chart where they think interest rates will be at the end of 2017, the end of 2018, the end of 2019, and then something they call the longer run. This is their way of really describing to us, or giving us their forward guidance on rate trajectory. What we've got on this chart is the June and then the September dots. And as you can see, looking at June compared to September, in September the Fed quite sharply overall on average revised down the trajectory of the rate hiking cycle. In the end, they said, well, look, rates are probably going to get to the same point in the longer run, up around 3% or just shy of 3%. But essentially what they said was, it's going to take us a whole year longer to get there, which meant that hiking expectations for 2017 came down quite sharply, and indeed they did for 2018 as well. Obviously this was, the last time they updated this was in September, and of course we had election risk and of course Trump risk, but obviously the way markets have responded, we're pricing in now a big increase in growth and a big increase in inflation, and therefore markets are expecting the Fed on average to raise their dots. What will be most in focus will be the 2017 average dot plot, and in September this came in at just above 1%, implying between 1 and, let's just say 2. Okay, the average was 1.25%. Let's say the thought was that the Fed would hike twice in 2017. Okay, 2 hikes in 2017 was the idea. We are expecting this to maybe get revised up to 3 hikes. All that needs to happen is 2 of these dots need to be revised up. You only need 2 members to revise up their rate hiking trajectory for next year to see the average go from 2 hikes to 3 hikes. That's what we're kind of expecting to happen. All right. So will the Fed upgrade their growth forecast? Will they increase their inflation forecast? Will they raise their dots? Essentially, and to put more simply, do they think Trump is going to roll out a fiscal program, and do they think it's going to have an effect? That's really what we want the Fed to tell us today. Unfortunately, based on my experience, the Fed are going to prefer to remain on the fence. Typically, it's a hard thing to judge and predict, but normally the Fed prefer to be cautious, particularly when you've got someone like Yellen at the helm. So, I don't know, I got a feeling today that markets are expecting a kind of hawkish turn, and I got a feeling, given their track record, the Fed again might bottle it a little bit and prefer to be more cautious and therefore less hawkish, but we shall see. So it's all about the dots, it's all about the growth and inflation forecasts, rather than actually are they going to hike today or not, because they will. Now let's just quickly go back to that graphic I showed you a minute ago, which is looking at different scenarios tonight. Are we going to get a hawkish hike? Are we going to get a neutral hike? Are we going to get a dovish hike? So this is the scenario where we definitely get a hike, but then what's their forward guidance for 2017? Is it hawkish, where they upgrade the dots, they upgrade their growth forecast, they upgrade the inflation forecast, and it turns out to be more hawkish than expected? Or flip side, the reverse, do they hike today and then don't raise their growth or inflation forecasts? Do not raise their dots? And then how are markets, different assets going to behave? What's interesting about this is, check out the equity one. So this is Deutsche Bank's view, I should add. They think equities are going to go higher no matter what happens. They think it literally doesn't matter if the Fed are hawkish or dovish, the equity space goes up. I'm not sure I agree with that. I actually, and this will be contradictory to normal thought, but I've got a sneaky suspicion that if the Fed are dovish, well, no, I might change my comment. If the Fed don't hike, then I actually think equities sell off, because then it's just all about the fact that the Fed dropped the ball. If they do hike and they're dovish, okay, maybe Deutsche are right here. If the Fed hike and they're dovish, well, fine, then that's potentially a positive, you might say, for risk assets. If they hike and they're hawkish, well, traders are going to say, well, right, this is even more evidence that Trump's going to deliver his program and it's going to deliver growth. And, this is more evidence that the economy's really going to start motoring next year. And you could say that will lead to a further rotation out of the bond market space, and money, as I said at the start of this briefing, for the lack of a better place to put it, goes into the equity space. So maybe Deutsche are right, if they hike, of course. Anyway, we'll come back to this later, because we're going to do a full sort of Fed-only briefing in the run-up to that. We do have other stuff happening today. Just one thing before I'll come back to actually that. Just in terms of the data, we do have quite a busy day. Starting at 9:30, we've got the unemployment data from the UK. We're expecting the unemployment rate to stay unchanged at 4.8%. Jobless claims, or the claimant count change, we're expecting that to go up marginally by 5.5%. So that'll be UK stuff. We obviously had inflation stuff out of the UK yesterday, and so far the inflation story is panning out as most people have been expecting, and that inflation ticks up to a new 2-year high as we get the devaluing pound begin to feed through into an increase in import prices. So the economic honeymoon period since Brexit vote looks to be slipping away, but we'll see, and we expect that story to continue into 2017. Look at this afternoon then. We've actually got quite a bit out of the US, and definitely headlining will be the retail sales figures. This is due at 1:30. Just a quick look at this. Look, we've got a forecast of 0.3%. We've actually had a couple of big months in a row for retail sales. If you look at this chart, check out the September and October readings. Big double positives here stacked together. We haven't had a 2-month period this good for the whole year, as you can see. We are expecting another positive print here, but a smaller one at plus 0.3%. But it'll extend this run of avoiding negative slips that was typical at the first half of this year. So we're looking for the 8th reading in a row without or the 8th reading in a row above zero, with then some of these readings being quite powerfully positive. Industrial production, PPI data as well. Industrial production at 2:15. We get the oil inventory data at 3:30. The numbers we got last night from the API were bearish in terms of showing quite big builds. So crude build of 4.68 million barrels. The gasoline number was interesting in that it was the biggest build since the very start of the year. So we'll check out what the Department of Energy have got to say for themselves. We're actually expecting a drawdown on crude, according to this calendar here. We're expecting almost a 1.5 million drawdown. So that'll come at 3:30. This is all ahead of the Fed. Do bear in mind, though, the big event is the Fed. So perhaps, therefore, market reactions to any of this stuff could be a little bit more muted than you might expect. Final couple of points to make before I just finish on the charts. If you're ever trading or investing or thinking about whether, trying to decide where markets are going to go, maybe you'll feel a little bit of comfort in the fact that actually, well, I guess technically nobody knows because you can't predict the future. But what's quite interesting is today we've got two of the big players in this industry rolling out a dollar view for 2017, and Goldman's are very bullish. Goldman's expect further dollar strength as the market reprices more tightening from the Fed. So the mighty Goldman Sachs, they think the dollar's rally is going to continue into 2017. On the very same day, Barclays have come out with precisely the opposite forecast. They think, and they're issuing guidance to their clients, book profit on this dollar rally now. It's done. And actually the dollar is going to sell off as we get into 2017. The fiscal program from Trump isn't going to be as powerful as people expect. The Fed aren't going to hike, therefore, at a faster rate, blah, blah, blah. So you've got two of the industry's giants here with precisely the opposite view. And it's just quite refreshing to know that actually nobody knows. And hopefully that makes it a little bit easier for you to deal with the uncertainty you might have with your own view. Take some comfort in the fact that even the industry giants can't agree on how things might pan out. Let's finish on the charts. I'm going to go back to my screenshot of the charts here. We've got, and let's just talk quickly about oil. We've obviously had that build on the API last night, and so technically this is looking pretty interesting now. We've had a move down overnight, of course, off the back of these numbers, and flirting with the bottom of the week's range. We had a powerful gap higher, of course, on Monday following the deal, the non-OPEC agreement on also joining in and cutting production. We did have a headline related to that about half an hour ago. Russia said they're not considering cutting their oil exports. They're only looking to cut production. So slightly waters down the effect of a Russian production cut. Available supply to international customers is to remain the same, and they're just going to perhaps eat into some of their own personal reserves, but still, the oil price hasn't really taken any interest in that headline. But technically this is key, right? $52, very important. If I just add another line in here, look at last week's high at 51.66. Really interesting gap here. If we get a break below S1 and 52, I would suggest you'll get a very quick gap fill down to 51.66. I'm just going. Obviously, the Department of Energy inventory numbers at 3:30 are going to be key. If we are still above this gap at that point, then if we do get bearish numbers, you're going to get a pretty quick fill of this gap. However, if you look at a daily chart, and kind of just and let me just bring a daily continuation. Sorry, yeah, that's better. So look, we've got this $52 idea, but then let me just add a line. But the summer's high is just below it at 51.93 on a continuation chart. That was the October, not the summer high, the mid-October high. So keep your eye on that price point as well, just below $52. That puts it kind of slap in the middle of that gap I was just talking about. That just slightly confuses matters. But look, the point I want to make is, technically, we're definitely still very positive here. We have still broken out of the 12-month more. If you look at the weekly chart, we are trading at levels not seen since the summer of 2015. So really, and if you look back at the summer's high, that's the summer of 2016 high, that was at 51.67, which very interestingly is pretty much at the bottom of the gap that we have between Friday and Monday's price points. So this gap's really interesting, not only looking at the 1 hour chart, but actually looking at the longer term back over the year. Okay, so this is why it's so important. I would say even if we get a gap fill, as long as we stay above 51.60, really we're still technically bullish. But of course a break back below 51.60, and maybe then this starts to look like a false breakout, and maybe we'll pull back towards the 50 handle, but we'll see. But for now, despite the bearish numbers overnight, we are still in a technically bullish situation, especially if we stay above $52. So equities have come off their kind of that kind of injection higher from yesterday. It's all a bit flat this morning. I think that Italian bank rally has just drifted away. We're now focusing on the Fed. Is it going to be a hawkish hike? Is it going to be a dovish hike? We've had a bit of dollar strength, having seen the euro dollar flirt with yesterday's high earlier on. We've seen that reverse back, and now we're right down testing yesterday afternoon's lows. Or yesterday, the 7 p.m. lows. So a bit of dollar strength has come through, but we're kind of all within and contained within yesterday's ranges to this point. Same goes for cable. So there we are. I'd say keep it kind of tight. Certainly this morning, things are looking a little bit lethargic. We got that UK data in 25 minutes on the unemployment stuff. Retail sales is then key at 1:30. I'd say then it's the Department of Energy numbers at 3:30, and then finally the big event, which is the Fed, 7 p.m. and 7:30 p.m. All right, guys, that's it for now. Enjoy the session. Thanks very much.